This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
In any event, Patrick, what also is coming, and we're glad to have you back from a 2-week break, is another big picture trading chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not registered yet. Just go to macrovoices.com, look for the red button that says Looking for the Downloads, right above Professor Stephanie Kelton's picture. Patrick, diving into the chart deck, we've got the S&P 500 futures chart on page 2. What's going on here?
Well, here we are in the pre-elections. I mean, we're a stone throw away from seeing what is the outcome. And it's a little surprising how narrow of a range the S&P has been in. I mean, when you go back to look at what was going on in July and August, we were seeing this huge parabolic rise in the markets. Things were accelerating. Those FANG stocks were on fire. We were way overdue for a market correction. And, well, September did bring one about. But I was suspecting that it'd go a little longer, a little farther. But we really are at a stage at this moment where the very overbought condition that existed in the summer isn't there. It's far more of a range-bound price action. And so it is very likely in the post-election period that there is room for a bigger market reaction. So I thought on page 3 what was just relevant to reference what happened last time. So this is going back to the S&P chart in 2016, and most people are obviously familiar with this, but it was a surprise when Trump won, and the market initially took it negatively, and in the after hours, the S&P plunged lower. But if you didn't have access to the futures markets in the after hours, you literally didn't have a chance to react on it, because by the time the markets were trading the next day, they were already heading to turning up on the day. And that was a surprise. The thing is that if Trump wins this time, I don't think it's going to catch market participants by surprise, even though, everyone's arguing about what the odds are. I think everyone that is neutral recognizes that there's an equal probability that the election can swing either way. And so the question really becomes, is there a room for a risk-off event on the stock market? And, the one thing is that in my 20 years of trading experience and having gone through so many market crashes in the past, the one thing I've known is that rarely does the market crash on something that everyone is expecting, planning, and or analyzing. Almost always a market event happens when the market is blindsided by something that it wasn't expecting. And therefore, this election has been, over the last 6 months, one of the most anticipated things. The likelihood that some big, huge, volatile event happens in the S&P, that window is closing on that pretty quickly here. Later in the chart book, we'll talk about how the volatility in the markets is setting up. But certainly at this stage, the market is likely to find this little range pocket going into the elections, and then we'll see where it goes from there.
Well, Patrick, one place where I strongly agree is I think the setup here is going to be for a move up in stock prices after it's crystal clear to everyone and all disagreement is over with respect to who's president of the United States. The thing is, that's not going to be known on election night this time around. And it's just, in my mind, it's all about the question of, okay, so that means there's a chance of a risk-off down in price event starting on election night or even before then, until we figure out that it's clear. And, do we have to have the Supreme Court tell us what the outcome is? What's it going to take? We're in uncharted territory. So I don't know how big the down is, but I think the down eventually sets up a viable dip, and that's the opportunity to see a rally, because once we know and this certainty has been resolved, I think with either candidate, the market's ready to move up.
Absolutely. I think there's a lot of traders that have been de-risking and deleveraging and raising some cash just to reduce the overall volatility into the elections. And once there's clarity, there is certainly the potential for money flow to come back into the market, at least initially. There's a lot of different scenarios that can play out, especially if there's a blue wave sweep that could be interpreted bearishly down the road. But at least initially, I think that all of this anxiety going into the elections has lots of room for money to be put back to work once there's clarity on that. Anyway, let's move on to chart 4. And what I continue to find fascinating is just how the dollar has remained non-committal. And even there were a number of these attempts for the US dollar to rally, which would be a euro breakdown on this chart. But each time, US dollar weakness seems to prevail. And when we go to chart 5, it seems to be so evident on the US dollar against that Japanese yen. And we find ourselves retesting at this moment those August and September lows. And the big question here was that breakdown we saw the other day, the beginning of potentially a retest of the March lows. And we see that US dollar yen heading down to the 101 level. Nonetheless, dollar weakness continues to be dominant. And every time the bulls have tried to turn that trend, they've been turned away. And that's we have to respect that prevailing trend that continues to dominate here, right?
Patrick, let's move on to Bitcoin on page 6. I'm particularly curious about Bitcoin's outperformance relative to gold, because it's easy to look at this Bitcoin chart by itself and say, oh, it must be anticipation of uncertainty around the election. That's what's driving it higher. But, if that was it, gold ought to be doing the same thing, and it's not.
Exactly. And so big breakout on Bitcoin. Certainly, there's no other way to put it. I mean, when it's breaking to a 52-week high, especially on such kind of a tailwind, then it's certainly a trend that's established, and we have to respect that. But what's interesting is that when we look at gold, which is on page 7, you would think that gold would have a similar style uptick. And the reason we can draw that, at least have inferred that should have been happening. So if you go to page 8, while the implied volatility of Bitcoin, which is in orange, is obviously far greater, and therefore it shows that it's whipping greater here, but you can identify the correlation of gold and Bitcoin in terms of its movement against the dollar. And there's many occasions where gold and Bitcoin have trended in the same direction, and we've truly seen a divergence here where gold has really stayed range bound and Bitcoin has taken off. I mean, we saw similar situations in the past, back in the start of the year and a few other times where this happened, and often gold has caught up. And so it's going to be really interesting to see whether gold is just a laggard here and that Bitcoin is advertising that there's room for gold to go, or whether they're finally going to decouple here and maybe Bitcoin's going to march to the beat of its own drum.
Moving on to page 9, crude oil, my own favorite chart. What do you make of this? Because, boy, from a technical standpoint, this consolidation has been going on an awful long time now.
Oh, absolutely. It's been throughout September and most of October. There's just been such a tight range. And I think you've already discussed it when we were talking in the market wrap. But, the one question that I just wanted to ask here, we see this big pickup in yields because a lot of people are starting to anticipate or the idea that inflation is coming. But crude oil plays an important role in inflation expectations. And certainly we have not seen oil upticking that would create that kind of an assumption to be made. And I kind of just wanted to ask the question, could we really see inflation expectations continue to surge and all this to go and crude oil not break out? Maybe it can. And so certainly something that we're watching. I think that determining which way it's going to break out of this trend is going to be so crucial. Consolidations in oil could head down to the mid to low 30s if there was a catalyst for it on the interim. But I generally think that these energy markets are so oversold and so much of this bad news has already been baked into the cake that at some point the sentiment is going to start to shift in the space.
Well, Patrick, I agree. I think that we're definitely headed much higher on oil prices eventually. The thing is, I think the COVID crisis will take longer to play out than most people assume. So many people just have it in their head that a vaccine that's going to solve everything and the whole crisis comes to an end and everything goes back to normal just happens one day. There's no good reason to assume that. The SARS-CoV-2 virus is probably going to become endemic and we're going to have to learn to live with it. But sooner or later, the damage that's been done and the inability, as Art Berman has described, of the U.S. shale patch to really recover to its previous production, we've got to eventually get to much higher oil prices. The thing is, there's room to go lower first, and I think a return to $30 before we eventually move back to the 50 to 80 range is entirely possible here. So we'll have to wait and see how it plays out.
All right. Well, moving on to page 10, I just wanted to quickly talk about copper. Now, when you're looking actually right across the commodity complex, particularly the grains have been on fire for the last couple of weeks on the upside. But even here, we have copper breaking to a 52-week new high. And so while oil is staying in that pocket and staying very range-bound, we certainly do have a much broader commodity rally outside of gold and oil. And it's going to be really interesting to see whether these commodities continue to run. And certainly when we had that breakdown candle on copper that we talked about here on the show back at the start of October, we really were asking, was that a big breakdown move that was starting a correction? Well, almost immediately the bulls bought the dip and wiped out the breakdown candle within 3-4 sessions, and that just continues to demonstrate that this is very well accumulated, and the bull trend is pretty intact here on copper, and it will be interesting to see how high they're going to make this push. Maybe we can see something north of 3.25 towards 350 if this really gains some traction.
Let's move on to page 11 in the 530s yield curve. Boy, it looks like a new high.
Well, exactly. And this is interesting. And this comes back to that whole inflation expectations thing that we were talking about just earlier. I mean, really, we continue to see this bear steepening well underway. I mean, it's the long end of the curve that continues to see yields picking up. And when you're going into that shorter end, it's still very much pinned by the Fed on the downside. And to me, a real steepening should only really be happening when true inflation expectations are here. And we clearly are seeing a breakout. And so I asked the question, is that really showing that the market is now fully starting to price in this scenario that inflation is coming? I don't know. I've something in me, I don't know if I trust it. It will be interesting to see in the next week or two whether or not this breakout fades or whether it sticks. It's certainly going to be on my watch list of things to watch. But what I wanted to do, though, is move on page 12 to just look at those junk bond credit spreads. What I find fascinating here is that even though we have huge unemployment, potential on Main Street, USA, potential bankruptcies and small businesses and all sorts of other issues in there, I find it fascinating that there is no spike in credit risks showing on these spreads. Now, obviously, some people are saying that Fed manipulation is in full play here, but really, I'd buy that if we were talking investment grade bonds. But you would think that you would start to see some risk starting to be baked into the cake here, and really, this continues to be pinned very, very low certainly at 6-month lows on the bottom of that range. It'd be really interesting to see if in the post-election period whether we start to see some fear starting to be priced into these spreads.
Patrick, let's move on to the VIX on page 13. I notice it seems like there's a real pattern here where the VIX just doesn't want to move below 20 back down into the teens. What's going on there?
There's no shortage of traders out there that are drawing the little trend line breaks on the volatility index, trying to anticipate whether or not a new breakout in volatility is imminent. But I think that in the post-coronavirus market crash period, volatility has been at an elevated level largely because I think everyone was anticipating this volatility into the elections. And I think that there's a lot of risk risk at this stage to volatility in the post-election period. And I think what's a good idea to kind of anchor off of is if you look on page 14, when we look at what volatility did or volatility index did in 2016, we can see that right in the post-election period, we saw in that case almost a 50% wipeout of volatility premiums in a day. It was just extraordinary how volatility normalized in that post-election period. Now, I don't think we're going to see something as dramatic as that in this cycle. But when we do look at page 15 and see the way that the VIX term structure is set up, we have clear backwardation in that term structure, which is not normal. And when we're looking on the chart on the right-hand side there, we can see that natural contango in the VIX market is the natural place where it is. And one would think that this backwardation is really only there because of the election risk. And so one of the interesting things that I'm going to be watching here going into the next 2 weeks as we go past the elections is that will we see the collapse of this term structure pushing it back into either a flattening or an outright contango on the other side. I actually think that that's a very reasonable proposition that it actually plays out that way. And more importantly, this is going to have a pretty big impact on a lot of different option strategies, particularly when people are positioning themselves into the elections with options. What would happen if volatility was to substantially decline in that time frame? And so that is certainly something I think we're going to have to be watching. And I think traders, as being positioned with options into the elections, need to start to explore different ways to hedge out the risk that volatility can move against them and that vega risk that would exist in being long too much gamma. And so certainly something that we're going to be discussing in the weeks to come at Big Picture Trading.
What do you think about the time spread trade, maybe short February VIX futures, long May, anticipating that by February you'll get back to a normal contango structure in that curve?
I think it's a very reasonable proposition that happens. I don't see what the catalyst would be for the backwardation to exist, right? And so this readjusting, I think, is a very reasonable proposition and is certainly something that I think is a better odds than not.
Yeah, I'm just looking at this chart. My immediate reaction to it is I'm tempted by short February, long May. And the reason I say that is if we get all the way to February and we still don't know who the president of the United States is, it's not going to get any better by May. So, I think either we see a normal reversion of this curve, or you're going to get to the point where the longer dated vol is going to start to go through the roof too, as people anticipate whatever's still going on in February. If the Civil War has begun, it's only going to get worse by May. More likely, none of that happens and everything reverts to a normal structure. So I like short Feb, long May. I'm going to think about putting that one on myself.
So, Eric, I wanted to leave it with looking at page 16, looking at the S&P 500 volatility surface. Here I have it on the SPYs going out 4 months. And we see the typical fat left tail skew here. And what's interesting, if you look at that little green line down the middle, it's showing you where the at-the-money strikes are. We can clearly see the volatility premium picks up going out over the election, and the pre-election options are priced at a much lower vol premium. So there's clearly that volatility kink that's in there that is pricing that reaction in there. But I think that there are different ways to take advantage of this. And so that's one of the things I'm going to be doing is looking at what is the way that we can take advantage of that extra vol premium that's being priced in for election risk.
Speaking of election risk, Patrick, I want to move on to page 17 because you are holding a webinar specifically about how to hedge your portfolio during the U.S. elections, no matter who wins, which is obviously a very timely topic. Now, that's for your big picture trading clients. Can people who sign up for the free trial get in on that webinar as well?
Absolutely. So anyone who wants to join me on that webinar can just sign up for a 14-day trial and join me Thursday morning at 9:45 a.m. And we'll be covering all sorts of the different things to take into consideration. Obviously, the one thing that one has to reflect is that just buying a protective put or some other hedge for election risk really at this stage has more or less been fully priced in, and you're going to pay a pretty rich volatility premium. And so it's about how do you construct trades that can reduce the overall volatility of your portfolio and take advantage of the volatility pricing versus you just outright paying for all of that rich vol premium.
And the rest of the information about that free trial of Big Picture Trading is on page 18.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.